So you think the pound is going to continue to drop against the dollar?
Yes.
How low can it go? Because there's almost like that, the dollar pound parity feels like something to defend. Once we say it, like we will defend that with our might.
Yeah, but the thing is, the more that central banks try to defend a arbitrary line in the sand, the more likely it is to fail. We saw that with India. India actually put a soft floor under the rupee at 80. It lasted for maybe 6 weeks. Now it's 82 and falling.
So how low do you think the pound could drop?
No idea. It depends on how long these things go.
See, what I've made a decision to do is there is a scenario where it is the bottom and the pound has dropped this low before and come back. There is that scenario, and there's a scenario where it falls further. I'm essentially hedging by holding both.
That gets back to our original problem.
Thinking about money.
We shouldn't be. You have to worry about, am I going to, if I leave all my assets in the pound, am I going to be wiped out? That's the last thing that should happen in a monetary system.
Yep.
It's the worst case, because now you're not thinking, I can't go out and do this. I need to expand my business. I need to do this or that. I can't even think about that because I don't even know if I'm going to have cash that's worth anything in a week or 2 weeks or a month. It doesn't matter. The fact that you're even thinking about that seriously is an incredible impediment on the commercial system, incredible imposition on the commercial system that is a drag upon economic growth and sustainable systems.
But I don't want to do the opposite. I don't want to keep all my, although I wish I'd done this from the start of the year, but I don't want to keep all my money in the dollars in case somebody does something else and suddenly the pound massively rises against the dollar and if it went 25% up, I'd lose 25% of my money. It's like, what the fuck do I do here?
You wait for everything to clear up. Buy Bitcoin, I guess, right?
Buy Bitcoin. We've done enough of that. I think we just.
But see, that's the other issue. That cryptocurrencies, digital currencies, why have they experienced the Bitcoin winter or the crypto winter over the last year too?
Well, there's multiple reasons for that. They tend to go in cycles, and it very much went in the cycle. But there are other signals that it was a response to cheap credit and the tightening.
The Fed tells us what to do.
Fed tells us what to do. Risk on, risk off.
See, I would look at it the other way. The cycles are dollar cycles. 2017 and 2018 was a deflationary cycle in the euro dollar.
Right.
So we had the same thing, 21 into 22, deflationary cycle in the euro dollar. So
what's going to happen in 23, 24? Should we buy Bitcoin?
The bottom.
That's the bottom.
And we don't know what the bottom looks like just yet.
You think it's going to get worse?
Oh, that's what, again, I like to think of the year, because we can't directly observe what these banks are doing. The Eurodollar system as a whole is a black hole. And you can't directly observe a black hole, but you can tell what's going on in the black hole by how things are moving around it, right? How a star is orbiting around the black hole tells you something about the size of the black hole, how fast the star orbits, all that stuff. So we look at financial markets, we look at money market, look at the dollar's exchange value. All these things tell us what is actually going on in the Eurodollar, even if we can't directly observe it. And these things are not looking very good at all. We're talking about 2007 levels of inversion in Treasury and Eurodollar futures. Obviously, the dollar's exchange value is wrecking people everywhere around the world. So I'm not incredibly optimistic about this year into next year.
Is it worse? Is this a particularly worse scenario, or do you think it's just similar to 2007, 2008?
I don't want to make any direct comparison.
Right.
I'm just saying that the last time the markets told us that the monetary system was confronting this level of concern and uncertainty was in 2007. We're not going to have another 2008. That will never repeat. That doesn't mean we can't go through some really bad periods here, because we're already seen that happen around the world many times.
All right, you don't want to make any predictions,
no,
but
never make predictions.
How are you preparing?
How you're preparing is understanding what's going on, listening to the financial system.
No, how are you preparing?
How am I preparing?
Yeah, how are you preparing?
I'm being as safe and as risk averse as I possibly can.
So what is safe and risk averse right now?
It can be any number of things. And I don't want to give out investment advice. I don't want to get into any of that stuff.
Is the one indicator that would be contrary to that the unemployment rate?
No, because that's a lagging indicator. And it's also faulty because it doesn't take into account, in the US, the participation problem.
What does that mean?
Fewer people have come back to the labor force since 2020 or 2020. So the employment rate doesn't take into account all the people who didn't come back. We're just sort of supposed to ignore them.
Oh, I see.
The participation problem is a deflationary problem that John Maynard Keynes identified a century ago. But it happened starting in 2009, 2010, and we just ignored it. So we have fewer people working, but the unemployment goes down because we don't ignore all the fewer people who don't work. Why? Nobody knows. Nobody seems to know. Economists have said, well, Americans are lazy. They won't go back to school and learn new jobs. They're drug addicted. Any number of excuses that basically blames workers for what is a macro issue.
What do you think the reason for that is?
It's again, like we talked about, this commerce is spending too much time worrying about money. And so it's a drag on economic growth. Globalization, more inefficient economic systems means there's less opportunity to create sustainable enterprise that leads to employment. So I think the average American worker who's out of the labor force knows more about what's going on in the economy than every central banker and economist there is. Well, they can feel the fact that there is no jobs available because companies are struggling with all of these issues.
Well, people care now and they want to know.
Yes.
I mean, we see it with our numbers. We our podcast numbers are essentially a derivative of the Bitcoin price. When the price goes up, our downloads shoot up and we get a new base, but when it drops, it drops. We put out a show today with Lynn Alden talking about the crisis in Europe, straight line up. People want to know, because they want to protect themselves, because they know they're being fucked by the central banks.
They also know they're being lied to.
Yeah, of course.
That's the issue. I think again, it goes back to what it's instability. You can feel the instability, but you got Jay Powell on the TV saying, no worries, I got this covered. I'm going to hike rates and the economy's going to be just fine. There'll be a soft landing. We're all good. And everybody knows that's bullshit, right?
Because they bullshit about transitory.
The Fed, you have to understand what the Fed says in public is not what it says in private. You look at some of the academic studies, the literature, they know they have no idea what they're doing, but their job requires them to tell the public that they do. That's what really, again, the Eurodollar system put the Fed out of the money business. So what has the Fed been doing for the last 50 years? It's been in the business of convincing people that it's in the money business when it's not. But that requires putting on this facade that says, I know everything that's going on. But then you read the academic studies and the literature that says, we have no fucking clue what we're doing here.
Do you support the idea of ending the Fed? And do you think the economy can operate without a central bank?
The U.S. economy's best growth period was before the Federal Reserve was instituted.
Really?
Yeah, before 1913.
Tell me about that, because I know nothing about
the late 19th century? Absolutely. I mean, boom bust cycles left and right. You can understand why the original Fed came about was because the private banking system did a relatively decent to lousy job at times of liquidity and elasticity. And so people said, let's create a public utility so we don't have to depend on the Chicago clearinghouse to create clearinghouse debt certificates whenever there's a monetary crisis. Let's have a public utility that has the mandate to create elasticity during crisis so we don't go through these boom bust cycles. And it was a total disaster because within 2 decades, we had the Great Depression, the worst of the worst case. So the idea that the Fed could, or the government could create a perfect elasticity machine to make sure the monetary system was in working order through the ups and downs of the boom bust cycle was total hubris.
So we better off just accepting boom bust cycles?
I don't think we need to accept them in the most extreme cases. I think we need to accept the fact that there are boom bust cycles because human beings are human beings.
Yeah.
And so we cannot perfect humanity. How are we going to perfect a complex human interrelationship? I think the idea is more along the lines to make sure it doesn't get too far out of tolerances in either direction. We don't want to be too constrictive. We also don't want to be too tolerant.
Okay, if you support the idea of ending the Fed, do you think it could ever realistically happen?
Yes.
You do?
Absolutely.
Because of public response or political will?
Just what you said. People are interested in the topic in a way. Trust me, I've been doing this a long time. And when I first started, nobody cared.
Yeah.
Who are you? What are you talking about? Eurodollar, banks? No, we don't care. Alan Greenspan's maestro, right? And now things have really changed. It just needs to get to a critical mass where people who are asking questions get connected with the ideas that answer those questions.
Do we know of any politicians who particularly stand for ending the Fed?
I'm sure there are some, but I don't know.
Probably Ron Paul.
Yeah.
Dr. Ron Paul probably.
He was all at the Fed, wasn't he, at least?
Yeah, what good is that going to do? We know the Fed is really transparent. Auditing the Fed, there's no hidden secrets there. It's really the Fed doesn't do the job that it was designed to do. And that was because they can't. They literally cannot do that job anymore because of the monetary and banking evolution a long time ago.
Jesus. I don't know what to do, Danny. Okay, so it is a particularly difficult time for people. In the UK, it is particularly difficult as well because we also have this energy crisis, which is really, really causing a lot of people and a lot of problems for a lot of businesses. I'm particularly worried that the UK economy could go into a specific and deep crash. How you don't want to do predictions?
No, but we can talk about probabilities.
Yeah, probabilities. Like, what are the probabilities of certain scenarios then?
Well, look, I mean, again, look, what the financial market is saying is the probabilities of downside cases have accelerated.
Yes,
that's what's accelerated, not consumer prices. Downside cases have accelerated. I mean, for the first time in September, the German curve inverted. Never happened before. What does that tell you? We have an unprecedented German curve inversion. That means that the financial system, the monetary system, focused on that particular part of Europe, is saying the downside case is something we've never confronted before. To the point that I would rather own a 30-year German bond than even a 10-year or a 5-year. That's an extreme downside case. A probability where what we used to call tail risk is not so tail. It's not such a tail anymore.
What is the reason to own different length bonds then? Because I don't know anything about bond trading. Never bought a bond. I've never traded a bond. Why is a 30-year bond indicative of that?
Well, because
you're locking up your money.
No, it's about that's part of it. You're locking in returns because you think, well, interest rates, just in very generally broadly speaking, interest rates are going to go lower through time.
So you want to lock in an interest rate.
And it's also about liquidity factors involved too. But primarily when you see curve inversion, what you're saying is I want to own a 10-year because I think over the next couple of years, interest rates are going to go down to the point that owning the 10-year is going to be a tremendously profitable position. So the yield curve in the US is heavily inverted, where the 10-year is 40, sometimes 50 basis points below the 2-year, which means that the Fed is pressuring the front end of the curve through its rate hikes, and the market is waiting for the interest rates to go down, just waiting for that moment for the Fed to realize that it has screwed up so badly that it has to not just stop hiking rates, it has to actually aggressively cut them. And so not just treasuries, Eurodollar futures are all waiting for the moment Jay Powell gets on TV and says, oops, it's basically priced into all of these markets. And so what the question is, what is the market waiting? What is the oops? What is the moment there where Jay Powell has to say, I throw in the towel and I got to start cutting rates? And in this environment, it can't be anything good. It really can't be.
So do you think rates are going to be cut again?
Yeah, I think the markets have been absolutely sure about that. And they've been pricing this for quite a long time. And we continue to keep moving in that same direction. The Eurodollar curve inverted the first time last December. And as the curve, the initial inversion last December, everybody was talking about an economy that was red hot. Inflation was going to be forever, secular inflation, all that.
But inflation's dropping now.
What's that?
Inflation's dropping now.
Yeah. So in some places, maybe it's not as fast as most people would like, but my point was that when it first inverted in December, nobody was thinking that what we're seeing now is actually going to happen. The market has been ahead of events all the time. And if it's pricing next year or later this year, continuing on the same path, eventually you get to that oops moment for Jay Powell.
Cathie Wood kind of agreed with Jeff, really, that the supply shock component of inflation has not been really considered. This is something that you talked about. Other people disagree with you on, but we brought out that chart.
Absolutely.
We saw it post-World War II, and we saw it post-COVID. We've also got a supply shock in the energy markets in Europe, which have been driving inflation.
It's an intractable one, too. That's again, you get to the cross currents. The ECB is hiking rates. Is that going to bring down oil prices? Why is the ECB hiking rates? Because that's not how the ECB operates. What the Fed and the ECB are doing, you think that inflation is a very simple thing. Is there too much money or is there not? Well, the Fed couldn't tell you. The ECB couldn't tell you. So what do? They hike rates because they're worried oil prices are going to infect people's minds. You think I'm making this up, but I'm not. They're afraid that what will happen is inflation expectation will unanchor, like using their terminology. So they're hiking rates to manipulate the people, employers, investors, whatever, so that they don't think that high oil prices are going to stick around forever. It's all about psychological manipulation. It's not about actually cutting back on money supply. It's not really even about controlling the economy. It's about psychological manipulation. And so the ECB is focused on oil prices, which are going to go up and stay up for probably a prolonged period. And the Federal Reserve is focused on the unemployment rate, along with oil prices. Meanwhile, at the same time, economies are falling apart rapidly around the world. Central bankers around the world are complaining about rapid external monetary tightening, and they're all looking at this other things. So
everything's
you can
fucked.
see why. No, you can see why market curves are inverted.
Yeah,
Because
I get it.
the short run, interest rates are going to go up. In the long run, they're going to have to come down because the Fed's focused on this. The world is doing this.
Well, the high interest rates, again, I can only speak for the UK, but the high interest rates are potentially going to cause a housing crisis as well, because I've brought this up in a few interviews recently, but 300,000 people a month come off fixed rate interest and go onto variable rates, and people cannot afford
Right.
the massive jump in rates that we've seen. They cannot afford to pay their mortgages, which means we're going to have a oversupply of houses in the market, which is going to lead to a fall in housing prices. But also, on top of that, people can't afford the rates for the houses they wanted to buy previously. I mean, I think higher interest rates are a good thing, not a sharp increase.
Higher interest rates for the right reasons.
Yeah.
Not because the Fed said so, but because the economy is healing.
Yes.
If we had an actual rapid economic growth, we would easily absorb high interest rates, because it wouldn't be all at once. It would be slowly, gradually. And then you would have people who would get better job opportunities, there would be more jobs available. So they would be able to afford higher mortgage rates.
Yep.
But see, that's not what's happening here. We have an economy that's falling apart, and the Fed raising rates, or the Bank of England raising rates for totally illegitimate reasons.